hospital services, rent, food away from home inflation, the old Taco Bell indicator, all up. What sense is there to make of that, Jim? That inflation's just the market just not give a crap anymore?
We've said this before. In the short term, markets are a voting machine. In the short term, all that matters is buyers versus sellers, and a lot of the structural things that drive buying and selling have nothing to do with logic. And actually, in the words of George Costanza, if everything I've ever done wrong, maybe I should do the opposite. That's what I'm going to do. I'm going to do the opposite. And what happens during the summer of George is vol compression with little to no volume, a dispersion of the constituents of the index. And if you're going to push things away from each other and there's nothing going on, guess what's likely to happen? Those that are short are likely to have their shorts go higher, and those that are long are likely to see their longs go lower, and those that are long and short, like hedge funds, are likely to see both go in the opposite direction. It is a pain trade. And almost by definition, they are short things because they deserve to be short, logically, and they are long things because they deserve to be long, logically, yet they are all positioned logically in a way that is getting hurt. So the running of the memes happens in the summer. Retail wins, institutions lose, but not because retail is right, because the positioning at the institutional level is so big and there's so little volume, and dispersion pushes everything away from each other. So the answer, quite frankly, is to do the opposite, is to do the things that don't make sense, that are illogical, to fight the positioning, to squeeze the positioning. And again, positioning by definition is there because, generally speaking, it makes sense. Ironically, that intro that you have is very much at the core of what's happening this summer and what's driving a lot of it. So to start at the beginning, you have to understand Trump cannot replace Powell until June, which he'll automatically be replaced. He could on the grounds of cause or fraud, which they're trying to make a case for, but it's really a narrative. The best thing that could happen is that he could get the people and the markets to believe his threat of doing it. Because if he does, then markets will be supported. The 10-year yield will be for a bit held in check. The Fed's powers of projecting policy are its most powerful powers. Right? It's not actually moving the interest rate itself. It's projecting what they're going to do and moving the interest rates on the curve accordingly. That's what he's doing. That's what Trump is doing. He is projecting policy. He is essentially doing what a shadow Fed would do without putting a shadow Fed in. And by the way, that's the best thing. If he actually did replace Powell, that would be bad. The 10-year, by the way, if you watch what happened to the 10-year, it did not like the first kind of, is he actually going to do it? So there is this, actually, if he does it, that would have some disturbing effects, A. And B, I want to make a point. I think the market believes more that he can affect interest rate policy by doing that. What do you think all the Fed governors would do if he fired Powell? Do you think they'd be happy with Trump? Do you think they'd fall into line with the new chairman? No. You would have a situation where, if anything, they would be more likely to try and claim their independence and stick to their guns. Replacing the chair does not allow you to just move interest rate policy. So, yeah, I want to be clear. This is Trump being Trump and trying to create a confusion and control as much as he can in terms of narrative to push outcomes. It is not actually about replacing the Fed.
I would love to see a mini January 6th just with the Fed board, the Board of Governors, storming the... I don't even know what they're
Is Mike Pence still in danger in this situation?
Mike Pence is very much... He's always going to be in danger.
He's going, oh, not again.
He could... Well, so let's move on to the, you had mentioned before the show that you wanted to talk hedge funds. We've got here that global fund managers are rushing into equities at a record pace. Cash allocation has dropped to 3.9%, the second lowest in 12 years, according to a B of A survey of 175 participants with $434 billion in assets. So what's going on here?
Those are not hedge fund assets. Those are long, generally long assets, et cetera. So yes, and if you look at retail and you look at mom and pop, they're at the highest allocation they've ever been at, which is about 49% of all assets are now in equities, which is a crazy number. Just to give you a sense, that number was in the low 30s a decade or so, ago. So we are, right at record valuations on several metrics. You can go whether it's the Schiller, CAPE, or whether you're at Warren Buffett's favorite GDP over debt. Those two in particular get you to a point where you got to be questioning where things are on a macro basis. Now, we could have said the same things in 99 and the market rallied for another year before it topped. So are you going to get a blow off top is the real question in our view. And that could very well happen. That is probably one of two ways these things end historically. But I do feel strongly that we're in some type of topping process. You know, I've been through the 99, 2000 topping process. I've been through the 07, 08 topping process, looked at a lot of history and know how those things tend to work and why. This is checking all the boxes. Now, the question is, you know, will this end from here or 50% higher, and we can talk to kind of, or 30% higher. It's not just the summer of George, it's how much certain areas of the market have grown in the last several years and how much influence they're having on the big picture and what those dynamics are causing. And we're getting almost an identical set of circumstances as last summer, largely because of these dynamics. And at the core, we have rising interest rates, right, that we've seen happening for some time, and inability for them to come back down, and a fear, understandably so, that there's a high probability that global interest rates remain here or go higher. Given valuations, that's a big problem. I want to be clear, the most important thing in finance, period, the valuation of all assets, except for arguably Bitcoin and gold or something along those lines, is the discount rate. It's the long-term interest rate.
You just said a big thing, structured products
Yes.
that have basically tripled in the last few years.
That's
Correct
the
me if I'm
annual
wrong.
issuance, by the way,
Yeah.
of those structured products.
Structured products are basically things that hedge funds offer to their clients as a way
No,
to...
banks
No?
offer.
Banks offer.
So hedge funds, you can invest in a hedge fund. Hedge fund does non-correlated trading with leverage. But structured products are simply kind of options-like structures, right, that are packaged. They're not sold as options, but they basically say, hey, if the S&P doesn't lose more than 20%, right, in the next year, and it stays below a 20% gain for the next year, you will have a 5% yield on top of whatever the S&P 500 pays.
Ooh, on top of it.
Right. So
Damn,
if the
that
S&P
sounds
goes
like a
up
really good deal.
20, you make 25%. If it goes up 15, you make 20. If it goes down 5, you make 0. And so things, I'm just giving you, there's a million examples, but all that is selling a strangle, right, or a one-touch strangle versus, you're limiting your upside. These are option structures that are just paired. Now, these things don't, very interesting, right? If you only can make 5% in a market, the reason you can make that, by the way, is there's a cash yield that you can make from the efficiency of capital here as well. So as interest rates go up, you make you make that yield and you get some yield of a structured product. There's a much better set of outcomes when interest rates are higher for these entities or these structures. On top of that, the reason the value proposition is more appealing when interest rates are higher, as we were talking about, people want more non-correlated as well. So all of this is driving a desire for more non-correlated, but also more appealing returns from this asset class. And again, there's all kinds of structures there that can be structured through options that are more non-correlated that are appealing to people as an alternative. Yeah, do you have any questions?
Well,
You want to dive in?
I do have questions about the blow off top thing you're talking about. Is that something that you think? It sounds like you think that's where we're heading, right? A blow off top and then a longer decline.
I want to be clear. Everybody wants a two-dimensional prediction, right? What's going to happen in next week? There is a distribution of outcomes. Certain paths are dramatically more likely. That's what I'm trying to highlight. There's a dramatic value to knowing what paths are more likely. It is much easier to predict distribution, right, than it is to predict up-down. To some people, that sounds like a cop-out. Everybody's like, well, you said up and then it's down. Like, no. Understanding how the machine works and what the likely outcomes, if this, given that, I can tell you what is likely to happen if this, given that. And I can tell you where this is likely to go if certain things happen. But that is more complicated than saying, are we going up or going down? And we are at a fork that's very important in the road right now, really in the next month or two, right? That is going to determine one of two very likely paths. And one is a blow off top, right? And the other one is a boil the frog, slow decline at first. That's kind of starts rolling over slowly, kind of think 2022, before kind of kind of accelerating next year, early next year. But a lot of that timing has to do with geopolitics. It has to do with the CPI numbers and the data and everything that we're seeing, the tariffs, the political cycle. All of these things are part of that timing. The odds of one will become more dominant than the other. But Summer of George will resolve here. It did resolve.
It does sound like maybe with those two options, though, Trump might label you a card-carrying member of the Panicans.
I am not a panic. No, the reality is, unless we can, there are structural issues.
Yeah.
The weighing machine is not going to change. Those things matter over 4 years, 5 years, 10 years, right?